Oh yeah, I know. Well, I always try to like. Here you go.
I look like a
No, you guys don't. Oh. Oh, here we go. Okay. Good morning. Thanks everybody for joining us today. We're so excited to have you. I'm here with Christine Brown Murphy from Zacharia and Brown. Christine's a partner of Zacharia and Brown, and she provides advice and counsel to clients with their families in the area of asset protection, Medicaid eligibility for nursing home, veterans benefits eligibility, and other related estate planning, estate administration issues. So we're really lucky to have her here today. Christine and I have, I'm sorry, go ahead.
No, yeah, I'm so happy to be here with Melissa. So,
but we work together on various client cases, and we were talking a lot recently about how many of our clients are facing the responsibility of having to care for loved ones. This is happening, in the past, but also now because of COVID. This has really made the need more urgent for this type of planning. So we wanted to spend a little time with you today, talking to you about some strategies that could help you and some creative solutions to make sure that you're getting the best results if you are caring for a loved one and to help you through that time. So Christine's going to talk a little bit about the overall structure of Medicaid eligibility planning and some other things. We're going to have a nice conversation today. We figure will be about 45 minutes or so, and we'll open up for Q&A. So if anyone does have any questions during our presentation today or our chat, you can go ahead and use the chat feature, and we'll make sure we take a moment and pause and answer your questions. So thanks again for being here this morning. We're really excited.
Absolutely, I'm so excited to be here with Melissa. Melissa and I have had the pleasure of having a relationship with each other professionally and personally for a long time now, and I really trust the work that she does with our clients and how we are able to work together and accomplishing the goals for really some of the most vulnerable in our society and their families. As an elder law attorney, what we see in our office on a pretty regular basis are people who are dealing with crises, dealing with someone who is sick, dealing with how they're going to pay for very expensive care, is that okay? Okay. So we're good. And dealing with how they're going to pay with really expensive care, and the average cost of nursing home care in the Commonwealth of Pennsylvania exceeds $10,000 a month. So people are fearful about how they're going to protect the assets that they have worked very hard to accumulate over a lifetime, and how they're going to pay for that very expensive care. So what we have seen in our office over the last 5 or 6 months is COVID has had a dramatic impact on the type of care people receive, where they're getting the care, and who is providing that care. What we have also seen is that folks who need high levels of care are having a difficult time finding places, nursing homes, to provide that care. So what is happening in return is family members are providing that care. Really, maybe they don't have the skills to provide the care. They don't have any idea of what programs and benefits exist to provide that care. And so they're coming to us really frustrated and flustered and unsure about, how they can get the care that their parent or loved one needs and how to pay for it. So some of the things that Melissa and I discussed prior to this presentation today is we were looking for some statistics. And what I can tell you is I see not only the financial, or I should say, not only the emotional burden that folks take on when they choose to provide care for a loved one who requires a pretty high level of care, but also the financial burden that is posed on those folks who choose to take on that level of care. So some of the statistics that Melissa and I were able to secure was that 76% of working caregivers rely on their families and friends, meaning that they're not looking to the community, they're not looking to other resources to help provide them with care. And what I will say is that caregiver burnout is a real thing. I think myself, maybe Melissa's a few years younger than I am, but we classify ourselves as the sandwich generation. We are not only still raising our own children, and our children are pretty small and still have a lot of needs and responsibilities, but we're now also being we're also taking on the responsibility of caring for our parents.
Mm-hmm.
And, I think that to avoid caregiver burnout, which is a real thing, we need to have an understanding of what programs exist that can help supplement that care. So the goals that you have for yourself of keeping your loved one at home can actually be accomplished, right? We never want to see that an individual feels as if though they have failed at what they have tried to do, which is keeping their parent or loved one in the least restrictive environment. So if we're thinking about that, 60% of working caregivers are relying only on themselves or family members. There are a lot of programs out there that exist, and that's what we help folks do in our office. We help restructure assets so we can look to Medicaid programs, veterans benefits programs to help have money coming into the home to supplement the care that's being provided for the family members. And I think what ultimately happens when you're only relying upon yourself and other family members to provide care, if you have a full-time job, it's just unsustainable. It's unsustainable, and what ends up happening is someone ends up sacrificing their job. The average age of a caregiver is 49 years old. That's a couple of years, maybe a little more than a couple of years. Than me.
For most of our clients, though, that can be within 10 to 15 years of retirement, which is a very critical time in our retirement planning.
High earning years.
And at 49, many of them are actually still funding college education or have children that have graduated and are still at home that they're helping support, which goes back to what you were talking about with that sandwich generation. And they're thinking, how on earth can I quit my job to take care of mom when I still have to pay college tuition, when I still maybe have some debt I'm paying off, when I'm still trying to reach my own financial goals. So we see the same thing all the time from a financial perspective.
Yeah, absolutely. And the number that we were able to pin down, and I'm sure really if we compound this number, it could be much greater. But the amount of money that the average caregiver will lose by choosing to stop working is $303,000, almost $304,000 in wages, Social Security income, pension income over a lifetime. And that doesn't take into consideration, the additional costs that are incurred because you have a loved one living in your home with you, other consequences as a result of failing to be able to invest that money.
Sure. I mean, I think that's a great statistic, and statistics are always good. I would venture to say for many of the folks that we work with that number, if they are leaving the workforce early, even 3 or 4 or 5 years, is probably actually much higher than that. Because I think what most people don't realize in making that choice is that there are multiple impacts to your retirement income, to your current cash flow, and those considerations can be even more than having your Social Security be lower, your pension being lower, or the obvious ones of losing your wages. There are things like increase in healthcare expenses. If you're getting your benefits through work and you now are staying home to take care of mom and you don't have group benefits through your spouse, you have to pay for those things out of pocket as well. It can also negatively impact your retirement savings. So not only are you giving up the money that you would have been saving in those retirement vehicles and the tax deduction from that money, but you're giving up the employer match. Potentially, this could be even most probably damaging to like a pension calculation, which oftentimes is calculated on years of service. So even if you miss like the last 3 or 4 or 5 years of service that you otherwise would have had, many pension calculations operate on sort of like these hurdles where after you meet a certain criteria that you get most of the benefit. If you miss that, then you may be lowering your income substantially for the rest of your life. And those are just a few of the considerations that we find our clients facing. And that's not even really considering, okay, how are you going to meet your current cash flow needs with the increased expenses of having mom at home and maybe needing some relief, to make sure that there isn't caregiver burnout.
Absolutely. And so what are some of the solutions, I think, and these are the things that we talk about. And really each case is going to be different, but some of the solutions is, if you are considering, are you going to, reduce your hours, quit your job so that you can provide care for mom? Some of the things that we consider first are, can we devise a caregiver contract? And what a caregiver agreement is basically, it's a contract which identifies the services that you are providing to your loved one, and you will be paid a wage that is reasonable. That if it were not for you and mom had to hire a caregiver agency to come into the home to help provide her with care, what would that cost? Now, average hourly rate for a care agency, a home care agency, is probably somewhere in the ballpark of $25 an hour. So if you are providing that level of care, you have the right to receive payment through a contract. These are the things that you're probably already doing. So a lot of folks say, well, I don't feel right being paid by my parent, but the reality is that if you are sacrificing your work, and were it not for you providing that level of care to your parent, your mother or father or whomever you're providing the care for is going to need to be paying for that level of care somewhere. So are they needing the level of care of a personal care home or assisted living? So what do we do when we're structuring that contract? We look to what is the average cost. If mom or dad needed that level of care, it would cost $6,000 a month for mom to be residing in a personal care home. So we structure that agreement in which you can be paid $6,000 a month for the care you are providing to your parent. Does that include mom or dad moving into the home with you? If so, then that is a justifiable wage. If you are going into mom or dad's home and you are no longer living in your own home, that is absolutely a justifiable wage. And there are other things that we can consider to do, because what we're also looking to do when we're engaging in, okay, caregiver agreement, we know that that is going to be a way to help supplement your income needs on a monthly basis, because you have now left the workforce, you are no longer earning your salary. So this is a way to make up for that loss. So, well, what about some other ways, though, that we can restructure mom or dad's assets so that we can make sure we preserve them so that they can last as long as possible, and use some sort of programs and benefits that exist to help supplement the care that you're providing? Because even if you give up your job, you move into mom or dad's home, or they move into your home, you still need a break. Right? We can all use that additional care coming into the home. So we structure a way to actually help the individual become eligible for Medicaid programs. And a lot of folks think, Medicaid, how the heck am I going to ever become eligible for Medicaid? How's my parent ever going to become eligible for Medicaid? We do it every day. And it requires us to engage in a plan to protect the home, to protect the assets, and look to determine which program is best for mom or dad to enroll in. And there are really two that we look to. They're called home and community-based services, and one is called the LIFE program, and one is called the waiver program. The LIFE program is more like an adult daycare. So mom, dad, basically, they are picked up in the morning, they are taken to the center, and they get all of their medical care, they have activities, they have lunch, they can get a shower if they need a shower, and then at the end of the day, they are brought home. You do not need to worry about getting your loved one or parent prepared to go to the center. They will come in, take care of that. They also provide in-home care, and they also provide respite care. So if mom or dad, or you want to go away for the weekend with your family, and you need someone to take care of mom and dad, that's what that respite care is going to be for. Now, there are asset requirements because it is a Medicaid program. And so what we want to do is engage in a plan to protect the home and protect the assets so we can get eligible. What we never want to see people do is continue to write a check or spend down all of their money so they have nothing left. Once you have nothing left, you have no choices, right? You are stuck getting whatever programs and services exist. You will no longer have choices. So we always want to make sure we can engage in a plan that allows for us to protect those assets, get those services in the home, and then we have these assets on the side to supplement the services that are being provided for through these programs. So that LIFE program is that adult daycare program. The other program that a lot of people really like to enroll in is the aging waiver program. And that is when you can pick the home care agency of your choice, and it will be paid for by the state, by Medicaid. And again, there are asset income requirements, but that's what we're going to do. We're going to structure these assets to allow for you to become eligible for the programs. Did you want to interject something?
Oh,
no, okay. To allow you to become eligible for the program. So a lot of folks are worried about losing the family home. And so while the home is non-countable to be able to become eligible for these programs, if you receive or are a recipient of Medicaid benefits, Medicaid will have a claim against your estate when you pass away. So when we're taking these steps to get you eligible, we need to be thinking about, all right, you've worked to pay off your home, you've worked to accumulate these assets. We want to make sure that these assets are protected so they can pass on to your heirs when you pass away and that Medicaid doesn't get a claim against them. So there's a couple of things that we like to think about with regard to the family home. So if you have mom or dad come into your home, and Melissa and I talked about this a little bit, and about some of the pros and cons of it, it really does depend on the comfort level of the people that we're dealing with. So if we have mom or dad come into the home and they are now going to reside in your home, we want to think about, well, how can we get mom and dad's money spent down without it being viewed as a gift? So one of the things that we look to try and do is to evaluate, does it make sense for mom or dad to purchase an interest in your home? So if your home is worth $200,000, mom and dad, or mom or dad, could buy a 1/2 interest in your home. They could pay you $100,000. We prepare a new deed. The deed now says husband and wife, children, and dad or mom, or dad and mom, as joint tenants with rights of survivorship. That means, yes, mom and dad now own your home. The reason we like to consider that as a plan is because, again, we're looking, how can we get money spent down or restructured and be able to enroll mom and dad into these programs and this not be viewed as a gift? Because Medicaid and veterans benefits have some, they have rules with respect to gifts. Not many that we don't do it. We often do gifting. It just depends on the circumstance. But we want to make sure, how can we get these assets spent down and get them into these programs as quickly as possible? And so a lot of people think, well, am I going to lose my home if I add my parents onto the deed and they now own this property with me? And the reality is very unlikely. So if mom and dad own the home with you as joint tenants with rights of survivorship, they paid $100,000 for that interest. When mom and dad pass away, title fully vests in the surviving children. They now own their home again, 100%. They will pay inheritance tax on that 1/2 ownership, correct? So of course the children, husband and wife that own their 1/2, no inheritance tax on that portion, but the interest that mom or dad own now vests back in them and they will pay a 4.5% inheritance tax rate. But if we're able to save $100,000, does not
probably going to offset the
it's going to offset the inheritance tax of $4,500. So these are some things that we can consider. Does this make sense? Do we say, okay, maybe kids aren't comfortable with mom and dad owning them? Do we think about a rental agreement? And these are things we need to talk to our accountants and CPAs and see what makes sense with respect to a rental agreement. Do you have anything you want to add to that? I know we're not talking here.
No, that's perfect. I mean, because this is very, very helpful. I mean, I think part of the takeaway here is that most people don't even realize these strategies exist. Yeah. At least that's what I hear when people approach me with these sort of challenges that they're facing. Sure. They don't understand that there are these programs out there that can help them salvage some assets and save some money, but also get them their loved ones the care that they need. Exactly. Like the adult daycare program, as well as, and I'm sorry, the age waiver. I mean, those are programs that can, like you said, provide a lot of options, and that's what we try to do in the planning for our clients too. Is we don't always know what's going to come, but we know having options is going to give us the most flexibility in our planning as well.
Absolutely. Yeah, and I think one of the other things I want to point out about that waiver program is that if you are a child providing care to your parent and you don't necessarily want an agency to come into your home, we can actually work with the agency to hire you as a child. Okay. And so you now become the paid caregiver through the agency to provide that level of care to your parent. So there are so many strategies that exist. Yeah. If you have money, so a lot of folks think, that if they have money, there's no way that we can get them eligible for these programs. But the reality is the rules are really very flexible. If your spouses, I mean, I've had clients who are millionaires, and I had a client who, they owned their home. He had over $1 million in retirement funds. They had a couple $100,000 in other accounts. We were very easily able to get his wife, who had early onset dementia, eligible for the waiver program, Medicaid program. And the benefit of that program was that We got her onto Medicaid. She got the care in home. Not long thereafter, she had to have a placement in the nursing home. And the benefit of getting yourself enrolled in those programs while you're in the community is that it allows for an easy transition to a nursing home. Once you're eligible for Medicaid, for the waiver program in the community, you're eligible for Medicaid in the nursing home. So we don't have to worry about.
I didn't even think about that.
So you don't have to worry about the $10,000 or the $11,000 a month it's going to cost in the nursing home because you've already attained your Medicaid eligibility in the community. So it really is an opportunity to kind of think ahead of time. Where can you see your loved one 3 years from now, 2 years from now? If you see that they may need that level of care, right now is the time to plan for it.
Absolutely. And I do find that that's the most important thing is getting started with this planning early and having a plan.
Absolutely.
And I think those are all good strategies.
Yeah.
I mean, the care, and they all have different, like you said, tax implications, investment implications.
You have to consider all of them.
But there are really neat things that we can do. I mean, if you're collecting that income.
You know, Melissa, one of the questions I get from folks all the time is, where should I pull the money from if I'm paying for long-term care costs? And I think that we live in such a, you know, in a world where folks are so fearful of taxes, which nobody wants to pay taxes, right? Nobody. But, you know, maybe can you share what your suggestions or considerations should be about where do we look to first oftentimes when someone is paying for long-term care costs?
So from the standpoint of which account to take from, like IRA versus non-qualified versus annuity, I mean, that's highly contingent, I think, upon the person's personal situation. But oftentimes, I mean, it could make sense to spend down IRAs first, and that dovetails with some of your Medicaid planning because those are countable assets, are they not?
So for the individual who's applying for the program, the retirement funds are accountable, but for the spouse who's not applying, they're completely exempt. So we would never want to pull from the retirement fund. Yes, if the spouse was healthy, but the spouse who is in need of the care, we would not pull from those.
Yeah, I mean, so it depends really on two things. It depends on which type of account based on the Medicaid eligibility requirements that you would come up with. And what we often do, we'll kind of look at the different accounts and say, okay, what are the tax implications of this? What are the legal implications and Medicaid planning implications? And then we would try to look at spending down some of those assets that may be countable first. So one of the strategies we use is maybe topping off their income tax bracket to try to get the money out of the IRAs to spend those down first. I mean, that actually might work with the caregiver agreement arrangement too, because even though you're creating taxable income for the parent or the loved one that's receiving care, they also get a deduction for paying the caregiver that can offset that. So that could actually be a really nice strategy. It also depends how much money they have outside of the retirement plans and just in general what resources they have available. So I mean, I think the first thing to look at would be in determining where we withdraw from is how much they need. What are the tax implications, and then what are the legal / Medicaid planning implications, and then we kind of make a determination there. Sometimes it could be a combination of taking from both income sources. It also depends on whatever income the other spouse needs, because that spouse, you know, is what I believe you call the community spouse, is the spouse that's still kind of living their normal life in addition to now being a caretaker. There may be other expenses that they need to continue to pay for. So those would be some considerations that we would look at. I think secondly too, we would have to look at what the investments are themselves inside those buckets, because that's all those vehicles really are, is they're buckets. They're not investments. Some may be more aggressive, some may be more conservative, or some may be more liquid. So I think it really just depends. Unfortunately, I don't have an answer for, you know, exactly what that would look like.
I think though,
but all those things need to be considered.
Absolutely, and I think folks are always, you know, adverse to even looking at the retirement funds. And I think we both have the same philosophy. Somebody's going to pay taxes on those, right? And so we want to look at the circumstances. At some point, if you are paying high medical costs, if you're in a personal care home, assisted living, hiring a home care agency, getting care in a home, that very often is a time for us to look to start taking, you know, more withdrawals from our retirement fund at that time. And so there are certain scenarios that are going to exist where that definitely makes sense, because if you, the individual who owns that retirement fund, aren't the one pulling from it, and you have that passing on to your children, then your children are going to pay the taxes on it. Oftentimes when your children are still working, they're in the community, they have a higher, they're in a higher income tax bracket. So you know, we want to think about all these things. Who does it make sense to bear that tax consequence if we need to begin strategizing?
And I think one of the things that an advisor helps you do is look at taxes now, taxes sort of down the, like while this is happening, and then taxes down the road, like you said, when it comes from a legacy standpoint. Because oftentimes as advisors, we say, well, IRA assets are kind of the worst assets to inherit versus Roth or non-qualified, because the taxes are much lower on that from an income tax standpoint, and also from a capital gains tax standpoint. And I mean, there's the inheritance tax as well. And I think people sometimes don't realize that different assets are subject to different taxes when you pass away. It's not just inheritance tax, it's income tax, it's capital gains tax.
That's right. 100%.
And we have to look at those things as well.
Absolutely.
Yeah.
So one of the other things I want to talk about too is what if a child, and we get this call a lot, and I don't know if you experience this so much with your clients, but you know, we get the call a lot where there has been a child who maybe has been residing in mom and dad's home maybe their entire lives, or they recently moved into mom and dad's home, and they're concerned, what if my parent has to go into a nursing home, or you know, we apply for one of these programs, waiver or the life program, and you know, what do I do about this home? I've given everything up.
Right.
Right. I you know, a lot of times
Which
they're
happens
married,
so often.
or they move their families in, they stop working. What happens to me if my parent now goes to a nursing home, or when they die? At least what's going to happen to the home? And there's actually an exception in the law that a lot of people do not know about, and it's called the caretaker child exception. And what the caretaker child exception is if you are a child and you have been residing in the home with your parent for 2 years or more prior to them applying for this waiver program, the life program, or Medicaid in a nursing home, Medicaid actually permits for us to take the home and give it to the child. Now, typically, gifting has a 5-year look-back issue, and there are concerns that we have to address if we gift assets, but we are permitted to actually give the home to the child. What do we have to demonstrate to Medicaid? We have to demonstrate that that child, in fact, has resided there for 2 years, usually tax return, driver's license, something to demonstrate that they have resided there for 2 years or more, and then a letter from the parent's doctor. And that letter simply says that had it not been for this child, this parent would have required a higher level of care much sooner.
And then Medicaid would have paid for it anyway.
Exactly. So it's a gift. Essentially, the state is saying, thank you, child. We don't want, you know, for you to suffer the consequences of losing this home because you actually helped save us some money. And they allow for us to transfer that home. And I can't tell you the number of times that we see people having not taken advantage of that and losing that home, and now the child has nothing. You know, so it's really important for us to consider, you know, how do we make sure that the child who has sacrificed all of these things is actually being taken care of, right?
Yeah. Well, so I actually have a question for you that you just made me think of, because I think this comes up a lot. So do people often like try to sell the home to generate more money to pay for care, and then they basically create a kind of a bigger, is that's a problem, right? Because then that becomes an asset that isn't a home anymore. That exemption doesn't apply. Right. So it's like they're trying to do something good,
but it defeats the purpose. Putting more money into the estate to continue to try to pay privately almost never makes sense. You know, we can get you into these programs with assets, and by generating assets or converting assets or continuing to spend down or avoiding even looking at these programs, all you're doing is spending more money than you would ever have to. I mean, I have an appointment with a woman, I think it's tomorrow. Her husband has been in a nursing home for 4.5 years, and I looked at her questionnaire that she completed prior to coming in. The amount of money she spent that she never had to spend, it sickens me. Now,
and there's really no way to get that back. I mean, it's once it's gone, it's gone.
You cannot get it back. All she has left is her home. And they had hundreds and hundreds and hundreds of thousands of dollars. I mean, it's gone. No way to get it back.
And that, you know, I'm glad you said that, because that's one of the challenges that I see in this planning, and one of the biggest unknowns for my planning. When we get a client to retirement, I mean, we have calculated and do enough planning to get them to a pretty high probability of success to know that it's very unlikely that they're going to outlive their assets if we follow this plan we've put together, which is a solid plan. But the one thing that can derail it for us as planners, which I think is really under addressed in the planning world and just in general, is this spend down of assets to pay for long-term care, leaving the spouse that's in the community destitute or with very little resources.
Never happen.
Well, and I feel the same way, and I feel very passionate about that. And that's why, I mean, I'm glad we're doing this today, because I want to empower people to know that there are other resources
Absolutely.
and ways that we can structure things to make sure that that doesn't happen to you.
One of
And
the
we
things-
never want it to happen to our clients.
Absolutely. And one of the things I want to point out is so basic, and I know Melissa's probably sitting here and we talk about
No,
it. The power of attorney.
No,
Power of attorney.
I'm so glad you said
Yes, because the power of attorney is the document that allows us to do so much of this. Because the reality is, unfortunately, people don't think about it until they actually have a crisis. And when we then look to the document that's going to give us the authority to transfer assets, to change beneficiaries and retirement accounts, to liquidate an IRA, if that's what we have to do, that power of attorney has to give us that authority. And I can't tell you the number of documents I see come through my office, done by estate planning attorneys, which I always call myself an estate planning attorney, but on steroids, because we think about not only what happens when you die, but what happens when you get sick and need the $10,000 or $11,000 a month in care. We want to make sure our document addresses and allows for your agent, your spouse, or your child to take all of those steps necessary to protect them. I mean, Melissa, I had this
Thank you
situation.
for saying, yes.
It's
I mean,
true. It's true.
we run into this all
Yes.
the time. I explain to spouses, and they don't realize this, you know, and this happens a lot. We have spouses, one work, one stayed at home to care for the family. They have $1 million in an IRA, but it's all in Mr. and Mrs., right? And I explain to them, if your spouse calls in and asks for money from this IRA, if I don't have a
Yes.
POA on file, I can't even send you the money.
Yes.
Because I don't have anything appointing you as the agent
Exactly.
to direct these funds.
Well,
And I can't tell you how many people walk in here and say, oh, this attorney said I don't need a POA, or I just don't need one, or I got mine out of the Cracker Jack box, because every once in a while
they're
that
not
happens too.
obligated to say.
Okay, so I'm sorry, I know I interrupted there, but go ahead. You finish.
No. Well, I had a circumstance where I had a client and he had a nice size IRA. And he had been diagnosed with stage 4 pancreatic cancer, but his wife was in a nursing home with dementia. And we were able to obtain Medicaid eligibility. The problem is she was not able to sign a new power of attorney.
Sure.
And her old power of attorney did not allow for her agent to remove her as a beneficiary from any kind of retirement fund.